Hi, I'm Jenny Brown. Welcome to the final MFB news of 2022. I hope you're all very, very well. I hope your festive plans and celebrations are fully underway, going wonderfully, and you have some really, really gorgeous things lined up for the next week or so. Sadly, not to be in my house. We are a COVID house this week, so we are up to our eyeballs in germs and other deliciousness that goes with COVID. So I think our plans will be slightly more subdued than we'd been hoping for. But that's okay, right? As long as we come out the other side in one piece, that's what's most important. In terms of what we're going to do today, we're just going to have a quick look back over 2022, reflect on some of the key kind of things that have happened, what's been going on in the buy-to-let mortgage market, and then really consolidate that by just doing a recap on where things are at the moment in terms of pricing and also lending criteria. And I'm just going to share some thoughts on what we think is going to be going on in 2023. Then I'm going to be rounding off this week's and our final update for this year by bringing you up to speed on what's been happening with my own buy-to-let property. So for those of you who don't watch this regularly, I'm currently going through the journey of personally of trying to get back my buy-to-let property from non-paying tenants. So I'm just sharing that with you guys in the hope that if you unfortunately would have to go through this situation yourself, forewarned is forearmed, I think is the expression. So yeah, bringing you up to speed on that as well. Okay, so just looking back over 2022, I think it's been as a business for us a very, very, it's been a year of 3 quarters and 1 quarter actually. So the first 9 months of 2022 were for us incredibly busy. So what's been happening, I think, is that there's been a lot of people who've been moving house because of, it's really just the fallout of the people making delays because of Brexit, because of the COVID lockdowns, also because the housing market was running really, really hot. A lot of people simply weren't able to find new houses because there was a shortage of stock. So that's kind of protracted things as well. So the purchase market was running very, very hot and very, very busy for us. And this is UK-wide, this isn't a mortgages for business thing. Then add into that we've had a really, really kind of buoyant remortgage market. We've been watching interest rates, and for those of you who watch this video every week, you know we've been talking since the start of the year about interest rates are starting to increase because of inflation. So we've had a really strong remortgage market. And what we have seen is interest rates increasing as well. So I feel like it's been a very, very busy first 3 quarters of the year. Now, obviously, as a business for us, that's been wonderful. And we're really, really pleased that we've been able to lock in some really, really competitive fixed rates for our clients. That's been really, really great. So these guys are actually probably feeling incredibly good about the very wise financial decisions they made earlier this year in locking into those good deals. The fallout of this, unfortunately, was that I think it's fair to say that lenders' service struggled, lenders, solicitors, surveyors as well. Everybody just got very, very busy, and the service has been actually incredibly poor this year. And as a business, I think it's been quite tough for us, and therefore incredibly tough for our clients who have been doing mortgage transactions, because the whole thing has been very frustrating, very, very slow. So the first thing I really want to say is that if you have done a mortgage with us this year and that was your experience, thank you so much for bearing with us. You know, it's not how we normally like to do business. As a company, we pride ourselves on amazing customer service. Everything's very, very quick, very, very slick, but we've been really kind of, I don't want to say let down by the lenders, that's not fair because they've been doing their best too, but the whole thing has been not the greatest. Now, when we fast forward to September of this year, we had the mini budget spike. You guys will know that swap rates spiked. A lot of lenders pulled away from the market or put their rates up very, very high. That has slowed things down incredibly. So one of the good things, and one of the only good things that came out of the mini budget nightmare, was that we saw mortgage applications slow right down very, very rapidly. So the good news is that the lenders who were experiencing real issues with their service because they were just so busy are now largely up to date. So actually the good news is if you do apply for a mortgage at the moment, it's going to sell through nice and quickly, which is actually really important. I think, you know, everybody wants the cheapest interest rates, but likewise, if you're going to be waiting for 6 months with a lot of uncertainty set around it, that's not a good experience for you. So the good news is that things are kind of back up to where they should be in terms of service levels. So we have been seeing interest rates increasing over the year, and that kind of really segues very, very nicely into where we are right now. So for those of you who are interested in swap rates, 5-year swap rates are currently at 3.988, so just under 4%. Now they were actually almost below 3.7, I think, in the last couple of weeks. They've eked up a little bit, which is not what we want to be hearing. I suspect there's nothing too major to read into that. The market is always a little bit volatile and things do bounce around. but just know that 5-year swaps are currently sitting at just under 4%. So as I say, every week when you think about lenders' margins and how much margin they need to make in addition to their cost of funds, it sits between 2 and 2.5%. So in theory, 5-year fixed rates should be sitting at between 6 and 6.5%. Now the good news is actually at the moment there are 5-year fixed rates at way less than that, and I'll give you the current interest rates in a second. But I think really the key message is that 5-year swaps have really kind of settled at this level, so sort of between, it's going to sort of land between 3.5% and 4%. So for those of you who are waiting for really, really cheap interest rates to come back, you know, the reality is that isn't going to happen. We kind of are where we are now, and I think you kind of need to just buckle in and sort of sit this out for the next 12 months or so at least. Now, in terms of actual interest rates, the rates that lenders are charging, where are we? So we've got variable rates. This is, sorry, personal names, straightforward properties. So personal rates variable rates, sorry, put my teeth in, you can tell I'm not well, can't you? Variable rates from 3.59%. We've got 2-year fixed rates from 4.29%. We've got 5-year fixed rates from 4.69% and rates with no early repayment charges, which are variable, from 4.91%. Now we move into the limited company space now. So variable rates here are from 3.99%, 2-year fixes from 4.89%, 5-year fixes from 5.09%, sorry, and deals with no early repayment charges at all, which are variable, from 5.44%. Now for those people who are thinking about variable rate mortgages at the moment, it's worth just therefore looking forward just briefly into the kind of predictions of base rates. The base rate is now sitting at 3.5%. The more kind of optimistic amongst the economists are predicting it's going to go up to 4% and then stay there for 2023. Other people slightly more kind of negative or possibly more realistic economists are expecting base rate to go up by a further 1%. So when you're looking at those variable rates, just keep in mind that if you took a variable rate of 3.99, the reality is that this could end up at more like 4.99 at some point during 2023, which if you compare that to a 2-year fixed rate of 4.89, actually, you know, which one would you be better off on? And I think actually, you know, hindsight's going to be the really valuable thing in all of this, but just know that that's kind of what could happen. Now, what I wanted to do is just kind of also recap on lending criteria, because there's been so much change going on, and I think people are possibly sort of wondering, actually, you know, what even is lenders criteria at the moment. So just to kind of run through the key points. So at the moment, actually, for me, in terms of criteria, beyond the rental calculations being more onerous than they were because of the higher interest rates, actually nothing's really changed. So we can get up to 80% loan to value on buy-to-lets. At the moment, obviously there is a rental calculation sort of challenge in the background there, but 80% is still available. I'm not expecting 85% to come back at the moment, because the reality is that we are expecting house prices to soften somewhat over the next 12 months, and no lender's going to suddenly ramp up. Well, I'd be very surprised if a lender kind of suddenly increased their maximum loan to value in a declining housing market. It would be very sort of counterintuitive to do so. So I think probably 80% loan to value is where we're sticking for the time being. In terms of income requirements for buy-to-lets, what we have seen in the last 12 months is a lot of lenders come away from that arbitrary £25,000 a year income requirement and just say, look, we just need you to earn something. We don't mind how much that is, as long as it makes sense. So by that, what I mean is that if you had someone who was on £15,000 a year but had no borrowing at all, that would make sense. Someone who's on £22,000 a year but has got a home mortgage of, you know, 300,000, a car on finance, 20 grand on credit cards, that's going to make less sense, because the reality is the math simply doesn't stack up in terms of how that person can exist. Income requirements still £25,000 a year or nothing, or depending on which lender you're approaching. In terms of other stuff, so look, you can still get a buy-to-let mortgage if you're a first-time buyer, if you're a first-time landlord, or indeed if you're a landlord with, you know, an unlimited number of properties in the background. To give you some idea of the scale here, at Mortgages for Business, we have clients who have over 150 properties in their portfolio. These guys are still able to get mortgages as well. So there's always a lender for you, depending on the sort of exposure you have to the property market at the time being. Limited companies continue to be a really popular choice for landlords. I think now 75% of purchases are going through as limited companies rather than individual names, and that market continues to be incredibly strong. Companies that have just been set up, no problem. Companies that have been trading for a while, no problem. Companies which have unusual ownership structures, so laid companies, company owned by people, no problem. Also trading companies, we can deal with those as well. There's a home for those. So a trading company would be a company which is not just set up with the sole purpose of holding buy-to-let property. It does something else as well. That's no issues. Also, in terms of HMOs and multi-units, lots of lenders willing to lend on these. You tend to find that lenders class these properties in two segments, so smaller and larger. Smaller HMOs and multi-units would have 6 bedrooms or self-contained units, and larger would be anything above this. And these days we can go to HMOs and multi-units of up to 20 rooms or units. Anything beyond that we can still help, but you're going more into the commercial lending territory there. The key thing with HMOs and multi-units is some lenders do like you to have experience of letting property, and the scope of the experience can vary from must have had one buy-to-let property for 6 months all the way up to must have had 2 or 3 buy-to-lets for 2 or 3 years. But there are also lenders who will lend, particularly on the smaller HMOs and multi-units, lend to first-time landlords as well. So again, there's always a home for you. It's just a case of knowing which lenders to approach. Holiday lets were something which we were expecting to be fairly big business last year and this year. Last year it definitely was. It certainly slowed down a bit this year. Lots of lenders are still very much in that space. So 75% loan to value, I think realistically is probably your max LTV here. There are lenders who will underwrite the mortgage based on the actual holiday letting income. There are also those who are more kind of buy-to-let lenders that do a bit of holiday let lending. These guys will look at a notional rent as if the property was rented out on an AST. There are lenders who will lend on properties in holiday parks with restricted titles. So by that would mean that the holiday let will have a covenant against it saying that the property must be rented out for so many weeks of the year, or conversely, the owner must spend so many weeks a year in the property. Kind of peculiarities that come in particularly fairly strong holiday letting areas, so for example the Lake District. Anyway, the key point here is there is homes for these as well. So I think that really probably covers off the lion's share of the stuff we come across. The other thing that I think people are slightly more concerned about, we're seeing slightly, I say an uptick in, is minor adverse credit. Now, adverse credit is a whole video itself in terms of criteria. You know, there's such a varying broad range. So a defaulted mobile phone account from 5.5 years ago versus I missed my mortgage payment last month. Very, very different types of adverse credit. There are lenders who are very open to historic adverse, no problem. Something that was a one-off that's relatively minor very recently, it also can be kind of overlooked as well. So I think the reality here is that if you do have a blip on your credit report, don't think that it's the end of the world. There probably is going to be a home for you, but do give us a shout. But we're certainly seeing a very slight uptick in the number of people who are coming to us with the odd misdemeanor on their credit file. So that's really a look back on the last 12 months and just consolidating where we are at the moment in terms of looking forward to 2023. So I think we are going to see base rate go up by at least 0.5%, possibly by 1%, and I think that will shake out by the end of H1 in 2023, and that's going to largely hinge on what's going on in the background with inflation. For those of you who watch the news quite hawkishly in this regard, inflation is looking like it's peaked and it's starting to edge back down now. So that can be a good sign for us, but I think really it's just going to be very much a case of watch this space. In terms of fixed rate pricing, so we have got lenders who are saying to us, look, you know, we're going to bring something out in January, we'll be softening our rates. So you may see a slight decrease in pricing, but for those of you who are kind of sitting there waiting for your 2.99% 5-year fixed rates to come out, I'm afraid you're going to be really disappointed. I think realistically, you know, your 5-year fixed rates in very sort of vanilla, straightforward deals going to end up at around between 4.3 and 4.5. Specialist deals, so limited companies, multi-units, HMOs, that kind of stuff, you're probably looking at, you know, 5% as an sort of 4.8 to 5% as your 5-year fixes there. And when I'm quoting those lower interest rates, just know that they're going to come with larger arrangement fees. There will be also higher interest rates with low or no fees as well attached to them. We are expecting lenders to want to continue lending into next year. You know, we're not expecting anyone to kind of disappear and pull the rug on buy-to-let lending altogether. You may find if the property market does start to decline in terms of house prices, there might be a slight scaling back in terms of lenders' attitude to loan to values, but at the moment there's no signs of that. But actually we are expecting next year, dear God, please let it happen, for next year to be a fairly kind of staid year in terms of the mortgage market. Okay, and now just lastly, a brief update on the situation with me getting back my buy-to-let property. So a couple of weeks ago, I did my first video and talking about this and explained that my tenants were in arrears. We'd served the Section 21. The 2-month notice period had come and gone. The tenants had emailed the agent that manages this saying, actually, we're not moving out, we're waiting for the council to house us. So, you know, we're just staying put. So the process for me then was to basically take my case to a judge, demonstrate that I'd done all the right things and request possession of my property. So I've been working with a legal firm, sent them over a huge amount of money and also lots and lots of paperwork. Interestingly, after the video, one of my very, very charming clients emailed me saying, actually, Jenny, you know, you should serve a Section 8 at the same time, because if you're going to have any hope of being able to kind of recoup any of your unpaid rents and costs, you need a Section 8 to accompany this as well. So fortuitously, that was in the pipeline on the very good advice of my client, because on looking at the paperwork, the solicitor, as they were about to kind of get everything ready to send over to the judge for inspection, informed me that the estate agent had messed up the Section 21 and put the wrong date on it, which means it's invalid. So we're having to serve another Section 21, which is actually going out today. So my 2-month notice period on the Section 21 starts again. But thankfully, because we're able to use Section 8, because the client tenant is in more than 2 months worth of rent arrears, that will kind of fast forward things. So I think the first learning here would be check, double check and triple check all of your paperwork. Make sure it is absolutely perfect and watertight, because from what I'm hearing, the judges are very quick to find a mistake and throw your case out. Now, in terms of timelines on this, so my understanding is that my paperwork will go in front of the judge eventually, so the Section 8 will expedite this rather than having to wait for 2 months for the Section 21. But it's the now waiting game for the kind of timing for the judge to pick this up, and the courts are very, very slow at the moment. So I've been warned that this could take between 3 and 6 months to be looked at, which is absolutely devastating. What was quite interesting, actually, as an aside, is that the tenants have said they're waiting for the council to house them. The council won't house them unless they're made homeless. So I thought, you know, why don't I speak to the council and just trying to kind of understand the state of play here? So I phoned up Sevenoaks Council, who's our Sevenoaks Housing Association, and just spoke to them and just said that, you know, this is crazy. I've got a tenant who's not paying rent who I'm going to evict, so then you can house. You know, how long is your waiting list for housing? And also, why can't we find some arrangement between us here? You know, this is so silly that we're having to go through this whole series of hoops. You know, maybe you could just take the house off of me and rent it, because, you know, you're going to have to house them anyway eventually. So the first thing that I found out is that the waiting list for a house in my area is between 4 and 5 years, which is absolutely awful. So my poor tenants, I do feel actually really sorry for them, because when they do eventually have to move out of my house, I'm not entirely sure what's going to happen to them. I guess they get emergency housing, and then they're just going to be in this kind of limbo for, you know, 4 or 5 years. I find that absolutely awful. But the second thing was that the council said to me, you know, we're really sorry, but actually our department don't deal with that kind of arrangement. But we do have a department that would be interested in potentially talking to you about taking your house from you separately to the thing with the tenants. We're very, very short of houses. Someone will give you a call back. 2 weeks later, no phone call. I just find the whole thing so amazing. Anyways, that's where we are at the moment. So thank you to my client who messaged me about the Section 8. I really appreciate the advice, and actually it was the best advice I've had so far in this whole experience. But that's where we are. So hopefully when we pick these videos back up in January, I'll have some more positive news for you on this side of things. And that is everything from me this year, apart from just to say thank you. Thank you for watching the videos. Thank you for your lovely comments. Thank you so much for your lovely emails. It's wonderful that this video is interesting to the people that watch it, and also that you get something from it. So thank you very much for investing time in watching and listening to me as, you know, often as you feel that you need to. Have an incredible Christmas. I hope you all stay so very, very well and warm, and I will catch you again in 2023.